Listen, what I'm about to share with you isn't going to be easy to hear. But if you've got any wealth you're trying to protect, any retirement savings you're counting on, or any assets you think are safe right now, you need to understand what's happening in the next few weeks. Because while most people are distracted by holiday shopping and year-end planning, something absolutely massive is building in the financial system. And when it breaks, and it will break, the panic is going to be unlike anything we've seen in decades. I'm talking about a convergence of events that's creating the perfect storm. And gold and silver? They're not just going up. They're about to explode in a way that's going to catch 99% of investors completely off guard. Let me show you exactly what I'm seeing. Right now, central banks around the world just purchased 220 tons of gold in a single quarter. That's a 28% increase from the previous quarter. Think about that for a second. These are the institutions that print money. They control currencies. They have access to every financial instrument on the planet. And they're dumping their own paper currencies to buy physical gold at a pace we haven't seen since the 1970s. Why? What do they know that you don't? Here's what's really happening. Gold investment demand has climbed to over 1,460 tons through the first 3 quarters of this year. That's a 33% increase. But here's the kicker. Silver has outpaced gold with 71% growth compared to gold's 54%. And silver mine production? It's been decreasing year after year. You've got skyrocketing demand meeting shrinking supply. And the industrial applications for silver? They're not optional. Every solar panel, every electric vehicle, every 5G tower, every computer chip, they all require silver. There's no substitute. You can't just decide to use something else. So we've got central banks hoarding gold like it's the last lifeboat on the Titanic. We've got silver supply dropping while industrial demand is exploding. And we've got something else happening that nobody's talking about. The paper market is about to break. See, most people don't understand how gold and silver are actually traded. They think when you buy gold, you're buying gold. But that's not how it works. The COMEX, the London Bullion Market, these are paper markets. For every ounce of physical gold that exists, there are probably 100 paper claims on that same ounce. It's like a game of musical chairs, except there's one chair and 100 people playing. And the music is about to stop. Here's what I mean. When you look at the commercial positioning on the COMEX right now, the big banks are more short silver than they've been in years. They're betting the price goes down. But physical demand is going through the roof. Premiums on physical silver coins and bars are at levels we haven't seen since the 2020 panic. You know what that means? It means there's a massive disconnect between the paper price and the physical reality. And when that gap gets too wide, something has to give. Let me tell you a story about what happened in 1980. Most people know silver hit $50 an ounce that year. What they don't know is why it crashed. The Hunt brothers, these Texas oil billionaires, they figured out the same thing we're talking about right now. They realized the paper market was a fraud, so they started taking physical delivery. They bought silver futures contracts, and instead of just rolling them over like everyone else, they demanded the actual metal. And you know what happened? The COMEX changed the rules, literally changed the rules in the middle of the game. They made it illegal to take delivery beyond a certain amount. They forced liquidation. They crashed the price to save the banks. But here's the thing. That was 2 brothers with a few $1 billion. Today, we're talking about entire countries. We're talking about central banks with unlimited resources. We're talking about a global movement away from the dollar that involves half the world's population. The BRICS nations, Brazil, Russia, India, China, South Africa, they're building an alternative financial system. And it's backed by gold. They're not trying to hide it. They're announcing it. They're accumulating physical metal at a pace that makes the Hunt brothers look like they were buying coins at a pawn shop. China alone has been adding to their official gold reserves every single month. But here's what's interesting. Their official reserves are probably a fraction of what they actually hold, because they don't have to report everything, and they have every incentive to accumulate quietly before they make their move. Russia? After the sanctions, after the West froze their dollar reserves, they went all in on gold. They're settling trade in gold. They're backing their currency with gold. They're building a gold-backed payment system that bypasses SWIFT entirely. And it's not just them. Saudi Arabia, the country that's been the backbone of the petrodollar for 50 years, they're now accepting yuan for oil. They're talking about joining BRICS. They're diversifying away from dollars into gold. This is the end of an era, and most people have no idea it's happening. Now, let me connect this to something that's going to hit home for a lot of you watching this: your retirement accounts, your 401k, your IRA. You think that money is safe because it's in stocks and bonds, right? It's diversified, you've got a mix of assets. But here's the reality: it's all denominated in dollars. Every single asset in your retirement account is a claim on future dollars. And if those dollars are losing value, if the entire system is shifting away from the dollar as the global reserve currency, what do you think happens to your purchasing power? I'm not trying to scare you. I'm trying to wake you up. Because there's still time to do something about it. And one of the things a lot of smart investors are looking at right now is how to get physical gold into their retirement accounts without triggering taxes or penalties. I actually put together a free guide on exactly how gold IRAs work. It's in the description below. If you're sitting on $100,000 or more in retirement savings, it's worth understanding your options. The guide covers the whole process, the rules, the companies that handle it, everything you need to know. No obligation, just information. Check it out if that's relevant to your situation. All right, back to what's happening right now, because the timeline on this is compressing faster than anyone expected. JP Morgan just released their latest gold price forecast, and they're calling for continued record highs through 2026. But here's what's interesting about their analysis. They're not basing it on inflation fears or currency debasement or any of the usual reasons. They're basing it on structural demand from central banks and the breakdown of the post-World War II monetary order. Think about what that means. The biggest bank in America is essentially saying the system is changing. The rules are different now, and gold is going to reflect that change. But it's not just JP Morgan. Goldman Sachs raised their price target. Bank of America raised their target. UBS, Credit Suisse. Every major institution is revising their forecasts higher, and they're all pointing to the same thing: central bank buying and geopolitical fragmentation. Now here's where it gets really interesting. The Western ETFs, the paper gold funds that had been bleeding assets for years, they're suddenly seeing inflows again. After years of outflows, Western investors are coming back to gold. And when Western money starts flowing into gold at the same time, Eastern central banks are buying physical. That's when you get a real squeeze. Because the ETFs have to buy physical gold to back their shares. They can't just create paper claims like the futures market. So you've got this massive new source of demand hitting a market that's already tight. And silver? Silver is even tighter. The silver market is tiny compared to gold. The entire above-ground supply of investment-grade silver is worth maybe $50 billion. That's less than the market cap of dozens of individual companies. It's a rounding error in the global financial system. But the industrial demand is enormous and growing. Every year, more silver gets consumed in industrial applications than gets mined. The deficit is being made up by above-ground stocks, but those stocks are finite, and they're shrinking. You know what happens when you have a tiny market with massive industrial demand and suddenly investment demand shows up? You get a price explosion that makes the 1980 spike look tame. Let me give you some context on just how explosive silver can be. In 2011, silver went from $18 to $49 in less than 6 months. That's a 172% gain in half a year, and that was just on investment demand and some supply concerns. We didn't have the industrial demand we have now. We didn't have the supply deficits we have now. We didn't have central banks buying gold and creating a halo effect on silver. Now imagine what happens when all those factors converge at once. But here's the thing that's really going to trigger the panic, and this is what most people aren't seeing yet. The commercial banks that are short silver on the COMEX, they're not just betting on lower prices. They're providing liquidity to the market. They're the market makers. They're the ones who are supposed to have the metal to deliver if someone demands physical. But what if they don't? What if the paper claims exceed the physical metal by so much that they can't actually deliver? What happens then? Well, we've seen it before. In 2008, there was a brief moment when you couldn't buy physical silver at any price. The paper price was $9, but dealers were out of stock. Premiums went to 50%, 100%, 200% over spot. People were paying $20 for silver that was supposedly worth $9 on paper. That was a liquidity crisis in the banking system. This time, it's going to be a crisis in the monetary system itself, and it's going to be much, much bigger. Here's another piece of the puzzle: the mining companies, the actual companies that dig gold and silver out of the ground. They're not increasing production. In fact, many of them are struggling to maintain current production levels. The easy deposits have been mined. The ore grades are declining, the costs are rising, and the permitting process for new mines takes a decade or more. So even if prices go to the moon, you can't just turn on new supply. It doesn't work that way, which means any increase in demand has to be met by higher prices. There's no other mechanism to balance the market, and the demand is coming from everywhere. You've got central banks buying for monetary reserves. You've got industrial users buying for manufacturing. You've got investors buying for protection. You've got countries buying to back new currency systems. You've got pension funds and sovereign wealth funds diversifying into hard assets. It's a perfect storm of demand hitting a supply wall, and the price is going to have to adjust to reflect that reality. Now let me tell you what's going to happen when the panic starts. Because it's not going to be a gradual thing, it's going to be sudden. One day everything is going to seem normal. The next day there's going to be a headline. Maybe it's a bank failure. Maybe it's a currency crisis. Maybe it's a geopolitical event. But something is going to trigger a rush to safety. And when that happens, everyone is going to try to buy gold and silver at the same time. The dealers are going to run out of inventory. The premiums are going to explode. The delivery times are going to stretch from days to weeks to months. And the paper price is going to disconnect completely from the physical price. You're going to see silver trading at $30 on the COMEX while dealers are charging $50 for physical coins. You're going to see gold at $3,000 on the screen while you can't actually buy any at that price. And that's when the real panic sets in, because people are going to realize the paper market is a fiction, the real market is physical metal, and there's not enough to go around. This is what happened in 1933 when Roosevelt confiscated gold. The government knew there wasn't enough gold to back all the dollars in circulation. So they changed the rules. They made it illegal to own gold. They forced everyone to sell at $20 an ounce. Then they revalued it to $35. Instant 75% devaluation of the dollar against gold. Could it happen again? I don't know. But I know governments do desperate things when their currencies are threatened. And I know the smart money is positioning for exactly this kind of scenario. Look at what the ultra-wealthy are doing. They're not just buying gold ETFs. They're buying physical gold and storing it in private vaults in Switzerland, Singapore, Dubai. They're taking it out of the banking system entirely. They're treating it like the ultimate insurance policy. And they're doing it quietly. Because they don't want to start a panic. They don't want everyone else to figure it out before they're fully positioned. But the signs are there if you know where to look. The vault demand in Singapore has exploded. The private storage facilities in Switzerland are expanding. The refineries are running at full capacity trying to keep up with demand for physical bars and coins. This is all happening right now, while most people are completely oblivious. Here's another thing that's going to shock people: the ratio between gold and silver. Historically, silver has traded at about 15 to 1 against gold, meaning 15 ounces of silver equals 1 ounce of gold. That ratio is based on the relative abundance of the metals in the Earth's crust. Right now, the ratio is around 80 to 1. Silver is historically cheap compared to gold. And when that ratio starts to correct, when silver starts catching up to gold, the moves are going to be violent. We're talking about silver potentially doubling or tripling, while gold goes up 50%. That's how these ratio corrections work. And there's a fundamental reason for it. Gold is primarily a monetary metal. Silver is both monetary and industrial. So when you get a monetary crisis, gold moves first. But when you get a monetary crisis combined with an industrial supply shortage, silver moves harder and faster. We're setting up for exactly that scenario. The monetary crisis is already underway with central banks buying gold at record pace. The industrial supply shortage is already here with mine production declining and industrial demand increasing. The only thing missing is the catalyst that makes everyone realize it at the same time. And that catalyst is coming. It might be a bank failure in Europe. It might be a debt crisis in Japan. It might be a trade war escalation. It might be a geopolitical event in the Middle East. But something is going to break. And when it does, the rush to gold and silver is going to be unlike anything we've seen in our lifetimes. Now, I want to talk about something that doesn't get discussed enough: the psychology of what's happening. Because this isn't just about supply and demand. It's about trust. It's about confidence. It's about belief in the system. For 50 years, the world has operated on the assumption that the dollar is as good as gold. Better than gold, actually, because you can't email gold. You can't buy things online with gold. The dollar was convenient, liquid, universally accepted, and it was backed by the full faith and credit of the United States government. But what happens when that faith erodes? What happens when countries start questioning whether the U.S. can actually pay its debts? What happens when the weaponization of the dollar through sanctions makes other countries realize their dollar reserves can be frozen at any moment? You get a loss of confidence. And once confidence is lost, it's almost impossible to get back. That's what happened to the British pound after World War II. It was the global reserve currency for centuries. Then, almost overnight, it wasn't. The world moved to the dollar, and Britain never got that status back. The same thing is happening to the dollar right now. It's a slow-motion collapse of confidence, and gold is the beneficiary, because gold doesn't have counterparty risk. Gold can't be printed. Gold can't be frozen or sanctioned. Gold is the ultimate form of money that's been recognized for 5,000 years. And silver? Silver is gold's little brother. It moves with gold, but with more volatility, more upside potential, more risk, but more reward. And right now, with the industrial demand story on top of the monetary demand story, silver might actually be the better play. But here's what you need to understand. This isn't about making a quick profit. This isn't about trading in and out. This is about protecting your wealth from a systemic change that's already in motion. This is about having real assets when paper assets lose their value. Because that's what's coming. A revaluation of everything. Your house, your stocks, your bonds, your cash. They're all going to be worth less in real terms. Not because they're going down in nominal dollars, but because the dollars themselves are losing purchasing power. Gold and silver are going to reflect that loss of purchasing power. They're going to go up in dollar terms because the dollar is going down in real terms. It's not that gold is becoming more valuable. It's that the dollar is becoming less valuable. Gold is just the measuring stick that reveals the truth. And the truth is, we're at the end of a debt supercycle. We're at the end of a monetary experiment that started in 1971 when Nixon closed the gold window. For 50 years, we've been running on pure fiat currency with no backing. And it's worked, sort of, because everyone agreed to pretend it had value. But that agreement is breaking down. The BRICS nations aren't pretending anymore. The central banks aren't pretending anymore. The smart money isn't pretending anymore. They're all moving to real assets. They're all preparing for what comes next. And what comes next is either a massive devaluation of the dollar to inflate away the debt, or a restructuring of the entire global monetary system, or both. Either way, gold and silver are going to be revalued higher, much higher, because they're the only forms of money that can't be manipulated or printed into oblivion. Think about what that means for your wealth. If you're holding dollars or assets denominated in dollars, you're going to lose purchasing power. If you're holding gold and silver, you're going to preserve purchasing power. It's that simple. But the window to position yourself is closing. Because once the panic starts, once everyone figures this out at the same time, you won't be able to get physical metal at any reasonable price. The premiums will be astronomical. The wait times will be months. And you'll be competing with millions of other people who all woke up on the same day. That's why the smart money is moving now. That's why central banks are buying now. That's why the ultra-wealthy are taking delivery now. They're not waiting for confirmation. They're not waiting for the mainstream media to tell them it's okay. They're acting on what they see happening in the real world. And what they see is a system that's breaking, a monetary order that's ending, a transition that's already underway. And they're positioning themselves on the right side of that transition. The question is, are you? Are you going to wait until it's obvious to everyone? Or are you going to act while there's still time? Because I'm telling you, the time is running out. The convergence of events we're seeing right now, the central bank buying, the supply deficits, the geopolitical fragmentation, the loss of confidence in the dollar, this doesn't happen often. Maybe once in a generation, maybe once in a lifetime. And when it fully plays out, when the panic really hits, when the masses finally understand what's happening, it's going to be too late to protect yourself. The gold will be gone, the silver will be gone, and you'll be left holding paper that's rapidly losing value. So here's what I want you to do. I want you to take this seriously. I want you to look at your own financial situation and ask yourself, am I prepared for a monetary reset? Am I prepared for a dollar devaluation? Am I prepared for a crisis in confidence in the financial system? If the answer is no, then you need to take action. You need to allocate some portion of your wealth into physical gold and silver. Not paper gold, not ETFs, not mining stocks. Physical metal that you can hold in your hand or store in a secure vault. And you need to do it now, not next month, not next year, now. Because the signs are all there. The warning bells are ringing. The smart money is moving. And the only question is whether you're going to listen or whether you're going to ignore it until it's too late. This is your final warning. The mass panic is coming. The only question is whether you'll be prepared when it arrives. The choice is yours, but choose quickly, because time is running out.